Welcome everyone to today's webinar. I hope you are fine in these difficult times. Uh, Thank you for registering and thank you for attending live today. My name is Srinivas Kunte. I am the Director for Professional Learning and Advocacy at CFA Institute. Today's webinar is on the auto sector, the automobile sector, and analyzing the automobile sector. It's a different webinar compared to the last couple of webinars we have been having. If you recollect, the last webinars have been on portfolio management, the buy side, but now we've shifted attention to the sell side. The auto sector has been in the works, has been in the news for some time now, and for the right reasons because it's an important sector for India's economy. A large part of our GDP, I think 6%, 7% of our GDP is uh, coming through the auto sector. A huge amount of employment is happening towards the auto sector. So everybody is having their attention to what's happening. We are going to look at the sector today from an analyst viewpoint. A veteran analyst is going to share his insights on analyzing the sector. Specifically, we are going to look at what are the change catalysts, how do you value the sector, what is the toolkit that we should be using for valuing the sector, and so on and so forth. We are going to look at conceptual things, the whys, not the whats. So do please pay close attention to the concepts and do ask questions. We've got a 35 1 hour session, 35 minutes of presentation, followed by a very interactive Q&A. Keep your questions ready. And we've been very fortunate to get a really experienced analyst, Hitesh Goel, from Kotak, for doing this webinar talk. And I'm grateful to our member, Udit Gadia. I don't know if Udit, you're attending today, but I'm grateful for the introduction. And to Hitesh as well for doing this. Hitesh, many of you may know, he's a veteran really. He's been around. Hitesh is very well respected. He's had over 2 decades of experience. For over a decade, he has been leading Kotak Institutional Equities auto sector team. Prior to joining Kotak, Hitesh worked for Daiwa Securities. He was with Citi, and before that with JP Morgan as well. Hitesh is, of course, a top-ranked analyst in India. He has a PGDM degree from SP Jain and an engineering degree from Delhi College of Engineering. He's an active follower of cricket as well as badminton. Hitesh, with that introduction, over to you. Thank you again for doing this for us. Over to you.
Thanks, Srinivas, for the kind introduction. Hi, guys. Good evening to everybody. Without wasting too much time, I'll just talk about, what are the trends in the sector and how should you analyze this. So while, we can discuss about the questions and all post my session, I'll take just 35 minutes or so for my presentation. Now, if you look at the Indian automobile industry, generally people would like to know what kind of things impact the sector. How should we look at the sector? So it's a cyclical sector because it's linked to the economic cycles, and generally because India is a low income country, the discretionary consumption does go through a cycle, right? If then nominal growth, income growth comes down, or there's a shock in the economy, that does impact the automobile sector as well. We are also seeing of late that there is a lot of disruption impacting the sector globally in terms of shift towards cleaner technology like a EV or hybrid vehicles. In India, it's just taking some shape, which I'll talk about later. But these are the trends which are going to impact the sector in the next 10 years, right? 10 to 20 years. We are also committed to reduce our emission globally, right? So India has actually moved to a very tough regulatory environment in last 2-3 years, which has also impacted the sector volumes quite significantly because the cost of ownership has increased. I'll talk about it also later. COVID has had an impact on the economy and on the sector, but fortunately with COVID, actually the personal mobility is coming back. and the shared mobility has taken a hit, which is also a key factor which is going to drive the automobile sector for next 2-3 years. In my view, the sector growth long term is around 6 to 10% CAGR, depending on different segments that they're in the sector. Global automotive growth is much lower, around 2 to 3% CAGR. I'm talking about the overall auto industry. So generally, the growth prospects in Indian automobile industry is much higher than the global, because India is very low penetration currently. Another big driver, which is quite significant in my view, is exports. So if you look at India, India is very minuscule part of the global automobile export chain, right? It would be less than 2% in my view. And we are seeing a lot of companies going global or acquiring companies or exporting out of India, because India has good quality engineering talent. There's low cost advantage and a lot of R&D. A lot of global firms are also putting R&D focus on India, which is actually helping us develop globally competitive products. So India is actually, exports will be also a big driver going forward. Shift to electric mobility is something which can impact the near-term profitability of the industry, because it will require some scale to be built up in electric vehicles before the profitability touches close to the internal combustion engine vehicles. But this is something which is inevitable, and industry will have to go through this transition. If you look at the Indian OEMs, Indian OEMs have higher superior return ratios than global automotive firms, because in India the market shares in OEMs are quite consolidated, whereas globally it is quite diversified. So for that's why Indian auto companies are have a higher profitability and return on capital employed than global firms. Now, just to give a snapshot, what you can see actually while tracking the sector, there are various automobile data sources, automobile associations like India has SIAM, China has CAM, Europe has ACEA. Yeah, so there are a lot of these automobile data sources, automobile associations globally, which gives data on a regular basis. There are external websites like a Car Dekho, Car Wale, company websites, which helps you track the pricing of the models. You have to look at economic indicators and notifications from various data sources like RBI, ministry websites, CRISIL, to see the regulatory impact on sector. And then finally, you have to look at valuation. How will you value a company? Generally, we prefer doing a DCF and followed by relative valuations like a PE or EV/EBITDA multiples to come to some fair value of a company. This slide gives you a brief snapshot. If you look at this slide carefully, you can see that Indian OEMs are trading at a significantly higher multiples than the global OEMs. The key reason is, like I've told you, that growth is much higher in India, and also the return ratios are almost double that of global firms, right? So in that sense, that's why Indian companies trade at a higher PE EV/EBITDA than the global firms. Now, what has happened in last 2-3 years, right? Like I've talked to you about the industry has not grown much. Actually, it's declined from 19 levels. We know pandemic has hit in 21, but there was also changes in terms of safety regulation tightening, which happened in April 19. So ABS, CBS, and airbags became mandatory. There was also BS6 which came in, which has impacted the sector. We moved to a BS6 emission norms from BS4, which has led to a significant increase in vehicle prices, which has also led to a slowdown. So cost of ownership has gone up quite significantly in last few years in both two-wheeler and in the car segment. And it is going to remain high in 22 also, because of the commodity price increase and the fuel price which has gone up, right? On the other hand, there's been double whammy. We have not seen much income growth. So if you look at the economic slowdown started in late 2019, right? So we saw a decline in our nominal income in 2020, and in 21 we saw a decline. Although this is going to reverse, hopefully, if we don't see a third wave because of COVID. And maybe next 2-3 years we'll return back to a trend growth of 10-11% nominal GDP growth, which is also driving our estimates going forward. Now, if you look at our forecast generally, what are we are expecting? We are saying that 22 to 2022 will be more of a normalized year, because last year was a full lockdown. So we could see a 12% growth in two-wheeler and 30% growth in passenger vehicle. In commercial vehicles, we are already at a 15-year low in terms of volumes. So from here, you could see a 3 to 4 year cycle. And then from 23 onwards, we'll 23, 24 will return back to that 8 to 10% kind of CAGR in two-wheeler and passenger vehicle, whereas MHCV may still grow in double digits in 23, 24. Now, this is just a snapshot how the linkages between passenger vehicle and two-wheelers versus GDP growth. Although it doesn't hold too much, there are a lot of moving factors. It's not a simple correlation with the GDP growth, but I've just given you a sense. Generally, it's between 1 to 1.5x of the GDP growth. But last 10 years, this correlation has not held well. This slide gives you a sense on what has happened in last 10 years. Last 10 years, there's been no growth in the PV industry, right? So this is largely because of the various crises that we have seen. We have seen demonetization, we have seen banking crisis. So financing is also a very important part in to monitor in passenger vehicle sector, because 75% of vehicles are financed, right? 70 to 75%. So if there's a curtailment of finance by the banking industry in the sector, that impacts the volumes of the automobile sector, right? So we have seen demonetization, we have seen banking crisis, we have seen the stricter emission norms coming in, then we have seen the BS6 getting implemented, then COVID has come through. So these factors have led to a significant impact on the economy and on the sector also, and we have seen sector not grow much. Although I'll talk about that, what are the interesting trends despite this, despite this low volume CAGR. We have not seen much volume growth, but revenue of the industry has still grown. If you look at passenger car penetration in India, it is still very low, around 21 per thousand. This is lowest in the world. I mean, we can't even talk about, say, a US or a Japan, but China has also reached 190 per thousand persons. Just to give you a sense, Delhi is where we have one of the highest per capita income. We are close to 100 per thousand in Delhi. Delhi is still growing, but I think given the population density in India, I think India may saturate close to 120 to 150 per thousand per person penetration, rather than going to high levels of Europe or US or Japan, because of the population density that we have. This is an interesting slide I want to talk about, that we have in the PV industry, we have seen a shift towards compact SUVs. So the revenue CAGR has been still single digit CAGR in the industry despite no volume CAGR, because the compact SUVs have grown from almost negligible in 2012 to now 27% of the industry. This could even go to 40% of the industry in the next 5 years, given that most of the launches are happening here, and people want to buy SUVs. There's younger generation wants to buy more of SUVs, and the middle class, richer is becoming richer in that sense, and that divide has increased, right? So we have seen that there's not much impact on the premiumization in the automobile sector, despite the pandemic and the stricter regulations. This chart tells you about some data on capacity utilization. So capacity utilization has declined because the volume has come off, but the top two players are actually still operating at very high capacity utilization, like a Maruti or a Hyundai. The right hand chart also talks about market shares. We have seen Maruti kind of maintain that 50-51% market share, except for some fall in 21. But the major gainers have been new players like Kia with their new SUVs. Tata Motors has come back with their new launches, whereas the smaller players like the other MNCs and to some extent Mahindra has lost out in last 3-4 years. Also, we've seen that there's a shift towards petrol, right? So petrol CNG is becoming more popular fuel versus diesel. It's also happening in the compact SUV and the MPV segments, where diesel was a preferred fuel, because of BS6, the cost increase in diesel has increased quite significantly versus petrol. So there is a shift because of the cost of ownership being cheaper for petrol versus diesel. People have started to buy petrol more than diesel, right? So there's been a shift, and also stricter norms on CAFE and all also actually helps the petrol segment. I come to the two-wheeler industry. Two-wheeler industry is still grown better than the PV growth. The decline has been last 2 years, largely because of the BS6 norms and the safety norms tightening and the COVID. Otherwise, it was going at a trend growth till 2019. This will reverse, in my view, in next 2-3 years, but still, it's been not been as great CAGR as we've seen in the last decade. But the premiumization still continues. This is a chart which shows that the premium motorcycle segment is still mix is still increasing. In pandemic year also, it's gone up by to 27% of the industry versus 24% in 20. So we have seen that the premiumization has not stopped in both two-wheeler and the four-wheeler industry. If you look at the penetration levels, India is close to 13% per person penetration versus most of the bigger markets in two-wheelers like China, Indonesia. They are at a significantly at higher rate, at around 30% per person. So their households may even have two-wheelers because it's cheaper. The financing is quite available, and it's also in certain cities. China is a different animal because in China, in 200 cities, the two-wheelers, the petrol two-wheelers are banned, and there's a shift towards electric two-wheelers. So that's driving the change. In Indonesia, it's a very congested market. Indonesia, Thailand countries, so their two-wheelers are preferred. In Brazil, the scenario is quite different. Brazil has saturated much lower rate at around 8% penetration, and they moved to cars. India, because it's a low income country, we believe that India can move to around 25% of penetration per person as a peak rate from 13%. So there's still 15 years of 6-7% kind of growth in the industry left, according to us. On the right hand side and left hand side, I talk about the rural and urban mix. The penetration in rural is almost half that of urban India, and most of the volume growth will come from the rural India, but the premiumization will continue in urban India. So the premium vehicles will continue to sell in urban India. So there'll be a shift, but most of the penetration led increase will have to come from rural India in our view. This is a small, next 2-3 years forecast. We are building a 12% kind of growth in the industry for next year, and then 10% for next 2 years, largely banking on the shift toward personal mobility. And 2021 were really weak. So if you look at 2019 volumes were 21 million, that we are expecting will come only by 2024. So it's more of a catch up rather than a sustained kind of growth in the industry. Another big factor which I was talking about earlier was exports. Indians have done very well in exports. If you look at, especially in two-wheelers, Africa is the key market there. This chart tells you about the key motorcycle markets, right? So if you look at, we are very bullish on Africa. The penetration levels in Africa is only 1% per person. So it is almost 1/10 of India, right? So from that perspective, there's a long visibility of growth in Africa that could continue to grow in double digits. Indians are close to 42% market share in Africa, whereas Chinese are 50%, and they have gained massively in Indians have gained massively in Africa versus Chinese, right? And Japanese are a smaller market share because it's a low price point market, and Indian Chinese dominate that market. So we are, although in the bigger markets like China and all this, we don't expect much growth. Also in Southeast Asia, because penetrations are quite high, but we do expect good growth in Africa, South Asia, mostly Bangladesh, and Latin America from Colombia, Mexico, Argentina, these kind of countries. So there's a potential for Indian players to increase market share as well as growth. Market should also grow in these regions. This is a chart which shows you the market share of Indian OEMs market share in Africa. So you can see, I mean, in 2004, Indians had only 2% market share. They've increased to 37% market share by 2019. Bigger players are Bajaj and TVS, which have done phenomenally well in the African market. So this has been a bright spot for Indian two-wheeler sector. And most of the share gain has come from Chinese. Now I'll talk briefly about the CV commercial vehicle side. In commercial vehicles, again, it is it's a cyclical segment, significantly impacted by the freight growth in the economy and the economic growth, and also financing. So 95% of the vehicles are financed actually in CVs. And we have seen banking crisis, demonetization, Excel norms, revised Excel norms. So basically, government had put in regulations where 15% higher load could be carried in trucks, which has in 2020 this regulation came in, which impacted the overall system growth of the MHCV industry, because the freight, now you need fewer trucks to carry that same kind of load, right? So this had impact as well. And then they had BS6 and COVID, which actually led to a impact on the industry as well. Now it has come to a very low level. I mean, in 21, this industry size will be equal to uh, what we saw in 15 years ago, right? And if you look at replacement demand itself, would be close to 250,000 units going forward. So we expect this industry to be a 3-4 year CAGR, the good CAGR for next 3-4 years, which is just because replacement demand will come back and you will see freight growth coming back. Now, what you have to track in the sector is you don't get road freight tonnage so easily, but you have some numbers on rail freight tonnage. So there's, you can see between last 20 years, the railway freight has grown in 5% CAGR. The road tonnage CAGR has been 9% CAGR. But interestingly, in next 5 years, because of DFC coming in, we could see rail freight growing at a faster pace and the road tonnage coming to only 3-4% CAGR. So that could be a challenge for the industry in the long term, that if because railway is the cheaper mode of transport, and if railway continues to create infrastructure and the speed of trains goes up, you could see some impact on the heavy tonnage side of the CV industry. But on the bright spot, the light commercial vehicles will start increasing because there'll be hub and spoke model which will start proliferating mostly in the railway hubs, right? So that will have a positive impact on the LCVs. A brief outlook on the tractor industry. In tractors, it's close to 900,000 volumes now on an annual basis. But we are still way off from penetration peaking out here, because to just give you a sense, there are 90 million agri households in our country, right? But these are, a lot of them are marginal, which can't afford a tractor, right? But I think the sweet spot for a farmer to own a tractor on financing is around 5 acres. That is still 12 million farm households which can own a tractor, which can potentially own a tractor. Right now, only 7 million of those 12 million are owning a tractor. If you look at what is the increase in tractor population every year, it is close to 0.4, 0.5 million. So we still think that, if you look at, trends, basically, if the farmer income continues to increase at a 7% kind of CAGR going forward, your tractor prices don't increase more than 2% CAGR, this average land holding size required to own a tractor will also keep coming down and the penetration will increase. So we think industry can reach around 16 million population by FY36. So we can see a 6-7% kind of CAGR in the industry. In terms of market shares, this is quite consolidated. There's not market share changes which happen. M&M is the largest player, followed by TAFE, Sonalika Escorts, and John Deere. These are the major players. And we are not expecting much major changes in this market shares going forward. This just gives you a snapshot on the capacity utilization, the region-wise trends in the tractors. Tractor penetration state-wise, if you look at Punjab, Haryana, UP are very high penetrations, but there are pockets in South India, Central India, where you will see growth. Now, this is another big change which is happening, right? According to us, electric will be the growth driver for the industry because the bigger volumes is two-wheelers. And in two-wheelers and three-wheelers, we'll see a big change in electric, right? So in terms of volumes, if you look at, I think IC will not grow much in next 10 years. And according to us, it will be electric, which will see a 50% kind of CAGR. So you need to look at companies which can transition into electric quite quickly and suppliers which will benefit from electric, right? This chart on the right hand side gives you a sense on what is the cost of ownership right now of a Bajaj e-Chetak versus a Honda Activa. So if you look at this chart, We are also including here one battery replacement after 5 years, because most of Bajaj is only offering 50,000 kilometers as warranty of the battery, after which the battery actually performance comes down significantly. So we are assuming that in our numbers. Otherwise, in terms of after subsidy, the price difference is not much now between a Bajaj e-Chetak and Honda Activa in terms of scooter. So at 40,000 kilometers, even after assuming a battery replacement, your cost of ownership is quite attractive, because your scooter runs for say 100,000 kilometers. Life is much higher. So we think that by FY30, 50% of scooters will shift to electric. So that is going to be a big trend, and most of the OEMs have to shift towards electric. And we are also seeing a lot of startups also in this space, which are trying to get the share of this pie. In electric motorcycle, again, the similar math I've done. If there's a product called Revolt in the market and a Hero Splendor I've compared it with. Here again, the break even is around 45,000 kilometers. But this Revolt tends to be, I think it's a little underpowered. Battery size has to be higher in motorcycles. So maybe in motorcycles, we are not expecting a big shift. We are saying only 8% of the industry will shift to electric by 30. This could be faster if the battery prices starts coming down, and if it comes to $100, you could see even 20% of industry shifting to electric. Passenger vehicles is something which will be difficult to shift, because when we are comparing a Tata Nexon EV versus Hyundai EV, this is a Hyundai Venue. This is a compact SUV segment, right? I mean, in this segment again, Tata Nexon EV is giving only 120 kilometer kind of range, right? That's why it's cheap. But if I come to more 40 to 45 kilowatt hour batteries, which can give me 240, 300 kind of kilometer range, the price point goes to around 25 lakh. 2.5 million kind of price point, which is quite expensive. So we are not so bullish that even if the battery prices comes down to $120, the shift could be dramatic in the PV side. We still think 5 to 10% will be shift in electric and PVs, and still ICE and the CNG and those vehicles will dominate in the PV side. So that's it. That was the end of my presentation. I'll open it to questions now. Srinivas, up to you now.
Thank you, Hitesh. Lots and lots of questions. So the original list of questions that I gave to you probably have no chance if we were to deal with all these questions. But let me quickly begin. Hitesh, how has this pandemic changed an analyst's perspective of doing things? Before the call, before your presentation, we are discussing that you are doing all of these things over digital right now, right? I mean, you are not going to the factory offices, but you are actually asking somebody on the ground to do it. So how has this shifted?
Yeah, so like we were discussing, right? So basically, Zoom or this online platforms have been pretty good, and we're actually been pretty efficient, because you could do more calls in a day. Your traveling times have got cut off, so we could, if we were to go for a roadshow or something, we could do 7, maximum 8 meetings in a day. I've done 12 meetings also in a day, because you could do it back to back without getting on a Zoom platform, right? And it's convenient for the clients also to do these meetings, and it's cheaper because you don't have to go, the traveling cost and all gets saved. On the corporate side, again, because people, it's not been a challenge, because I've been tracking it for 15 years. I know people in the industry, so a lot of work gets done on phone. But for a new analyst, I think it's important to see the factories, it's important to see the dealerships, it's important to go and meet managements, because then only relationships get developed. And people share more when they are meeting you one-on-one rather than on a phone or a Zoom platform, right? So that also matters. But I think for me, it's not been much change. I mean, it's been actually more efficient working from home and on an online platform than on a physical basis.
Right. So what are some of the, imagine that, there are young analysts out here, although, some of them are experienced wealth managers and portfolio managers as well. So for somebody who's entering the auto sector, what are the 3, 4 must do things, including, watching your webinar?
So I think it seems, sorry, just a minute. Sorry. See, basically, for a auto, it seems a very easy sector to do because you get monthly volume. There's a lot of data in the sector, which high frequency data, which keeps on coming, right? So from that perspective, it seems a very easy sector to do, but there are a lot of regulatory changes and things which are changing in the industry. And if you have to make a mark in the sector, you have to start understanding what drives profitability of a company, why the company can retain its market share, right? And when the world is changing, how will each management's going to respond? What is global trends happening, right? So what is, say for example, Kia, Hyundai, what are the global portfolio, what they can bring into the industry, what is the challenge for Maruti, how will the distribution change in the EV world, right? So there are multiple things to be thought about. So I would say think more longer term, think more because that is going to drive the valuations of a company and how investors see the company. To companies which are relevant today, maybe 5 years down the line, they may not be relevant, right? And the valuations change, which is 10 years ago, with in last 10 years, Maruti may have traded at certain valuation. It may not be necessary in next 10 years, it will trade at that valuation. So looking at valuations from a historical perspective doesn't help, right? So you'll have to start looking at building more of your valuation models more on DCF, looking at the trends. I mean, also DCF has its challenges, everything has a challenge, but because we have to have some framework on valuation and how to look at stocks, you'll have to start building that in your assumptions in DCF, that, reasonable assumptions, and you have to have justification for those assumptions, and then you can see and advise clients on the valuations, that what can be a prospective valuation of this company. So I never look at the historical valuations actually, what historical valuations have been for the company, because it's irrelevant. What is relevant is how the growth prospects are for the company over next 5-10 years, and what is changing there. Can Maruti retain its market share? What is industry forecast assumptions, right? How the profitability will change. So a lot of things have to be modeled and understood while tracking the sector. So it's not only volumes and channel checks or talking to dealers and all that. You have to study a lot of global trends, technology changes. Even when you're doing not only auto OEMs, you're doing suppliers, right? In suppliers, you have to go deep down into each and every supplier to understand how can he grow higher than the industry. Either there's replacement, either exports or the content growth, or he's adding a new portfolio, or he's gaining market share within OEMs. There's so many things to really understand in a company.
Right. So you mentioned, talking about global, you mentioned that India deserves a higher PE, but you also said that you don't expect PV growth, right? Growth in PV for the next few years for the auto sector. So how do you really? But you also said that there's a CAGR, expected growth of CAGR 7%. So if you can quickly, in a minute or so, triangulate all of these trends, right? Higher PE.
So I said, so Shini, I said last 10 years, there's been not much growth. Next 2-3 years, because of low base, you will see growth, right? And then hopefully we don't take a call on economic cycles. We are building a 6-7% kind of GDP, real GDP, and 10-11% kind of nominal growth. If that holds, your sector should grow at a 7-8% CAGR, right?
Right.
And another anecdotal evidence you can look at is how Delhi has grown, right? So Delhi has moved to a 5,000 per capita income, right? So if you plot those models, at what time will India reach a 5,000 at a national level in terms of per capita income? Maybe in 2020, 30 to 35, somewhere there, right? So then if you model that and you pin that number of Delhi in terms of 100-120% per penetration, say in 2035, then what can be the growth of the sector, right? So it actually boils down to the income growth. Now there can be disparities. We can move to a model where the richer become richer, still become richer, and the middle class doesn't grow. Maybe that now GDP doesn't grow, right? So the disparity will definitely have an impact. But if the disparity doesn't worsen, and the mean income keeps on growing, I think 7-8% kind of is the mean trend.
Yeah. So Ajay Sharma has this question, which is very pertinent to your observation, that you are trying to model something like 120 people owning car per thousand, right? Now, So the convergence towards a US or a UK where people are owning, there are 800, 900 people and per thousand people owning cars. That's not, that's a pipe dream, right?
That is not going to happen because in India, the population density is very high, right? And we are not making too many cities as commercial centers, right? So there are 25, 30 cities where most of the economic activity is happening, right? You won't expect in US and all, you don't see there's so much area. We don't have so much area as such, right? So the population density is a critical factor, which
Right.
will depress the number in terms of there are not so many roads where vehicles can go. So car congestion can be a big issue in India. It's already in major cities, right?
Right. So this, I mean, do you, on the other hand, do you see, in other countries where the ownership ratio is very high because of, and of course, there's this pandemic that has come into play. But do you see that, the model that Uber got into place, where people are using public transport or shared cars? Do you see that ratio coming down and convergence somewhere in the middle?
So basically, see, in global, the share mobility was gaining trend before the pandemic, but after the pandemic, we have seen some impact on the shared mobility trend because people were worried about the infections and all that, right? And a personal mobility trend came back. If the world becomes normal post the pandemic, you would see shared mobility coming back because there are advantages to shared mobility, right? You don't have to own a third car or in a household you can easily take a cab, shared cab, and move to colleges and offices, right? So from in developed countries, in India, in Mumbai or congested Delhi and all that, it was anyways making a lot of sense because you didn't want to travel in a traffic for a long time, right? So people had chucked their second cars actually and were only using their first car. Even the person who was relatively well off, they were actually selling off the second cars and going in Uber and Ola, right? This is now because of pandemic, people again started to buy cars, and there's a long waiting period actually in cars in India right now, and also globally also because of the pent up demand. Next 1 year could be good in global demand. I think the shared mobility will come back at some point in time once.
Right. In your view, the bright spots, if I understood them right, are the two wheelers, and within two wheelers, the EV side of the two wheelers, and then there is Africa, and there's also the commercial vehicles, right? These are the top three spots, right?
Next 2 3 years, yes. So these are
Yeah.
the key growth areas.
Yeah. So that was Bhargavi's question really, that your growth is based on these aspects. But Sweta has got a related question. There's a semiconductor shortage happening, in rest of the world. So what impact does it have in India?
So in India, because it's a small, see, semiconductor usage in Indian automobiles is much lower than the global levels, so companies like Suzuki are managing India much better in terms of semiconductor shortages because Maruti is a bigger profit pool, whereas for the Suzuki globally. So Suzuki Maruti is managing it much better than the global level. So it's more of an issue globally. Mahindra had some issues. So some OEMs have issues, but they tend to because they had single suppliers and all that. But that has been sorted out. We are not hearing much a bigger impact in Indian auto industry, in India automobile OEMs about the semiconductor issue. Yes, globally it's an issue. So a lot of global OEMs, because the semiconductor percentage or the content is much higher globally in global vehicles, they are facing issues, and this could be throughout the whole year. But it's not like the industry will not grow. I mean, we are talking about from a planned production perspective. They're cutting production from a planned production perspective because last year was anyways significantly lower. We'll still see growth in the global automobile industry also. But yeah, it will not be up to the levels where demand is coming through. You could see some impact there.
Right. So, in that sense, one of our other members, Subramaniam, I think he's got a good question of how what is a differentiating factor for Indian auto companies for for their sales strategy, rural versus urban. What is it that they should be doing differently to
So
improve
different.
penetration?
Yeah, so see, distribution wise, obviously, we have seen that people have built their distribution already, right? So Maruti has a fairly big distribution. Maruti is also setting more distribution in villages and now trying to cover more going deeper into the hinterland, right? So their sales have been increasing in rural areas. So that is one, and mostly Hyundai and Tata Motors also following the same strategy in terms of going more interiors to get more growth. In terms of two-wheelers, I think penetration is already peaked. Nobody's talking about dealership expansion as such because they're already touching a lot of these smaller rural areas. Everybody is there right now, so it's not a big driver there. Uh, and also distribution patterns are changing, right? I mean, in electric two-wheeler, you don't need distributor, you don't need to go to a dealer. I mean, people are delivering vehicles at your doorstep, electric, and putting chargers at home and all that. So you don't need to go for servicing also for electric. They can come and check your vehicle at your home also. So the distribution patterns will change in electric, where you may not need distribution per se. That could lead to some impact on market shares as well, because I mean, I may be sitting in Bhopal, right? I mean, if there's no dealership also, people can deliver the vehicle to me, right? So that was a factor, where because earlier the OEMs only had distribution, so I used to buy the vehicle there because there was no other distributor or dealer there. So those patterns will also, business models will also change going forward. So firms have to be very agile. And in India, what happens is, in India, there's no multiple brand distribution, right? So it is mostly franchising model, right? So that's why the OEMs also command a very high market share, because there's no multiple brand dealerships which are selling multiple models. So OEMs have most of the say in how they are running the distribution. But this could change. But see, again, because it's a low income country, it may not happen at a very significant pace, especially on the distribution side, because there are challenges, right? I mean, there's power shortage. Not many villages you can have that kind of continued electricity. So it's not like immediately you'll see a major impact. But yeah, urban areas you will see impact. You could see impact on the electric side. So let's see what happens. But obviously, I mean, in electric side, you will see distribution models changing quite dramatically.
Right. So, I mean, coming back to the that particular point about models, because of EV, I mean, EV is going to happen if not now, if for two wheelers now, for four wheelers definitely in the next 5 years, right? So, how is the ecosystem going to change? And to my knowledge, the second related question is that, although we have got OEMs in India which are doing really well, the ancillary industry have not really come up. I mean, can you debate on that question, throw light on that question? The
So
auto
right now the volumes have been pretty low, right? So in electric, that's why the ancillary is not there, right? But now with the PLI scheme that government has launched for battery manufacturing in house, it's a very attractive scheme, and a lot of foreign players, will look at setting up manufacturing capacity inside. There are a lot of players who started looking at ABB, or a lot of these suppliers and all have started to look at motors and controllers they're making in India now. So most of these things can be made except for the battery cells, and all, where also government has launched this PLI scheme. So I think in next 5 years, you will see 70 to 80% of localization happening on this EV components also in India.
right.
So
So,
I think that is a big opportunity for the supplier guys to really ramp up their offerings in electric space.
yeah, there was a related question actually. I mean, the specific question is it's an anonymous attendee. Uh, the question raised was the right one in the sense that, how is the auto ancillary industry in India different from, let's say, Japan? In Japan, if you recollect, there was this company called Takata which went bankrupt, right? And it was the biggest airbag manufacturer in the world. So in that sense, you don't have that kind of a pre-existing auto ancillary industry in India. Is my understanding right?
So Indian auto supply industry is quite profitable because we are benefited from a lower cost base. In generally, we have been imbibing the Japanese production philosophy, so we are very efficient in terms of costs. So the bigger players like Madan Sumi have become global, right? It's top 20 players in automobile suppliers globally now. So some Samvardhana industry. Madan Sumi is actually one of the top players in auto ancillaries globally. Then you have sizable players like Bharat Forge, Endurance. There are a lot of good guys, a lot of good ancillaries, promoters who have come up and actually done much better here. And this is a time where they can actually scale up because the China manufacturing costs are becoming higher, right? And there's also China also tightening emission norms and all that. So we are seeing some business getting shifted to India, right? Because in terms of scale, so there's no major large economy except for Europe, US, and China. So if you have to produce low cost components, it is China or maybe India, right? So from a large scale component perspective, so a lot of investments are coming through in auto ancillaries. It's a time for the auto ancillary sector to increase their share from say 2% of the global ancillary industry, so maybe 10% in next 10 years. For that, they will have to uh, upgrade their R&D capabilities, increase their technology in the electric space and also in the IC space. So it's up to the each suppliers. You have to monitor each suppliers separately, but they're definitely good suppliers in India, and that's a big opportunity in my view.
Now, Arvind has got one question. We are going back to the modeling part. You mentioned about DCM models. So, how do you? What is your advice on modeling? Arvind Ramchandra's question actually. How do you model? Infrastructure. Population is an easy one. I guess it's tied to GDP per capita, and it's probably coming down. But how do you model some of these things and put them in the DCF model?
Yeah, so it's quite simple, right? So, for example, I have a view that maybe in 2035, India, for example, say for a PV sector, right, that it will reach, sorry.
Yeah.
So in the PV sector, I have a view that India will reach say 100 per thousand kind of penetration, right? So I pin that in 2035. I have the number today in terms of penetration per person. So then I plot the industry growth based on that number, right? A CAGR. I don't build in cycles in between this forecast period because that is futile exercise. You will not know when the economy is growing at 7% or 10%. So you build in a linear kind of CAGR beyond your forecast period. I mean, because I'm an analyst, I have to build 3-4 years forecast. So I have that view. Beyond that, it will be more of a linear CAGR in terms of industry growth. Then I will come to specific players like a Hyundai, Maruti when I'm modeling something, right? That what is its market share. Then I will look at the trends like, capabilities of Maruti in EV, capabilities of Maruti in SUV, what are the different segments in the industry. And then I will take a call on the model launches, and then I will take a call on the market share of Maruti, right? So that will give me Maruti's volume CAGR. Then I will forecast the mix and the inflation part to get to my ASPs and get to my revenue. After I get to my revenue, then I will have to take a call on the margins, right? So margins basically, first I'll have to see the contribution margins. So if there's no structural market share changes I'm seeing in my view, then I will not change my contribution margin, because the margins may change more because of the competition angle structurally rather than from this near-term headwinds on commodity costs and all that, which generally passed on with a lag, but it doesn't have a long-term implication on margin, right? It will be more if competition is becoming intense and you don't see Maruti retains market share, or just giving an example, so for a company, right? So then you build your margin assumption on contribution side, and then you will see if there is a plan from the company in terms of cost reduction, how they are going about it, whether because of the new changes in the industry, will the cost will come down. In certain cases, there is royalty impact and all that, with whether that is an impact. So then you got come to local costs, and then you build your EBITDA, the EBIT margins and all that, and then you come to the capex angle, because the asset turns generally in the industry, right? How the asset turns have behaved. Then you basically keep those asset turns in line, or if you have a view that there's a premiumization going to grow, your asset turns will also increase, right? So you'll have to model that. That will give you capex numbers, and then you come to a free cash flow number, right? And then you have to find out the cost of capital, right? So in case of auto companies in India, generally OEMs, they are net cash, they don't have debt, right? So cost of equity can vary between 11 to 12%, right? So that is the kind of cost of equity we take in our numbers, and then you basically discount it through cost of equity and get to a
That is a very insightful and comprehensive inside, viewpoint on how people should be doing these things. I wanted to understand, what about the forensics checks? People should be, of course, there are established measures, and you mentioned Maruti. I think the CMD at that point in time had written a very nice article, I think in Economic Times or Times of India, which said, why people should be truthful and the accounting that people should be actually doing to publish their books in the right way. So that was a call for action by one of the industry leaders. What should analysts be doing to protect themselves and their clients from financial shenanigans in the auto sector?
Yeah, so that's why a lot of these, buy side firms or sell side is actually having a special focus on forensics, right? So because, analysts are covering, say, 25, 30 stocks, it's not easy for you to really do a lot of forensic analysis. So a lot of brokerage houses are looking at forensic analysts separately or taking help from agencies who can actually look at, so you can look at annual reports, you can look at, and already you can talk to industry people to get a check, but then still there could be issues in terms of forensic. So there are a lot of multiple, so ESG is gaining a lot of trend, like environmental, social and governance, right? So there are a lot of things to be seen in that. In terms of governance, you can look at annual reports. If there's a red flag, you can look at audits, how audits have been done, what has been the management changes, what the promoter background. There are multiple things to be done in forensic, and it's not easy for an analyst. So if it's an established company, it's very easy because you have a track record. But when a new company is coming for an IPO, or where you're starting coverage or something like that, we do forensic checks as well on the promoters or on the company. If there has been legal complaints filed, or there's some audit remarks in annual reports or something like that, there's significant related party transactions, there's contingent liabilities, there are multiple things you can check, right? So if there is a problem in your annual report, is a major problem, then obviously you go deeper in terms of forensics, that why this is happening, why maybe the company is not paying the full tax rate. So you'll have to go into details why the company is not paying full tax rate. Do they have tax exemptions, or they are operating from a low tax regime? You have to get into those details. So for an analyst, you can go deeper dive into the annual report, and numbers talk a lot. And then basically try to get into details, do questioning from the management, talk to their competitors, right? Mostly the industry people know about each and every company, how the business is done and all that, right? So you need to do channel checks also with the competitors. They can tell you a lot of things about the company. Even, a supplier is coming for an IPO, you can talk to the OEMs because what is their reputation of the supplier with the OEMs. So these kind of things we keep on doing in terms of, it's a pretty exhaustive list. It depends on how much you want to get into, but yeah, forensics is becoming a very, very important part of investing now.
It could be one more separate session. But talking about ESG, I wanted to understand. You mentioned that there's not much demand in four-wheeler EV because of the battery dynamics that you mentioned. But could there be a push from the government? I mean, we are now already at BS7. Delhi smog is not going away. So I mean, I hope it goes away. But given what is, do you see a governmental push really, which is already there? I mean, I think there have been statements in terms of support for a EV policy. So how do you expect that dynamics to play in India?
So government is already pushing, but government has realized it is easy to push in the two-wheelers and three-wheelers, right? Because that is the easier segment to push, right? There's charging infrastructure is not a big worry in two-wheelers and three-wheelers, because you can charge at home, you can do battery swapping. In passenger vehicles, in a country like India, charging infrastructure also becomes a big issue, right? Because not many societies are geared to give you a separate charger. How will you charge in a slum, right? So, or how will you charge in Mumbai, right? In various societies, or in Delhi, where there's independent houses, there is no charging infrastructure. So that's a big challenge. Despite government push, also, if government comes and puts a ban on IC vehicles, that's a different thing. But purely because of incentives, I think still there's a long way away, because the price point also of the passenger vehicles in India is much lower than globally, right? And another thing you should understand is that government taxes the IC vehicles a lot, right? So it's a direct impact on the revenue as well. So if you go give a major incentives on electric, and electric picks up where you're not taking any taxes, right? There's no road tax, there's no registration tax, that will have impact on your fiscal, on your revenue collection as well, right? So you'll have to balance these things in terms of another policy that government is not talking about is blending ethanol in petrol, right? So you're investing in that infrastructure, right? You're investing in CNG stations globally. Sorry, in India, right? And across the states, you're setting CNG infrastructure. So you're putting a lot of money there as well, right? Then you totally change your philosophy and try to shift, force the industry to shift to electric by giving very high incentives or putting a ban or something, which can have a big impact on your revenue collection as well. So I think government is taking a middle path. Yes, obviously the emissions are important, and reducing emissions are important, which can be done through a combination of electric and ethanol blending, CNG push-up. So you can tend to could give industry time rather than forcing industry to really move to electric, because electric is not profitable right now also, right? So, and industry does employ a lot of people. So you can't just force the industry. Let the normal, battery prices coming down globally, let the normal course of action prevail, right? Whenever the consumers or the industry is ready to shift to electric, people will launch vehicles on electric.
So do you see, I mean, big picture thinking, do you see the biggest software maker, producer in the country becoming an auto company? Or do you see, where is that convergence taking place in India? We've got the best software experts here, working for corporations. Are we not creating autonomous driving car software? I mean, I see our folks going there and doing it. What about India? What is your read?
Yes, so I mean, globally, we're seeing already Google, Apple talking about electric car, Google talking about the autonomous car, right? So, because in electric vehicles, the number of parts are much lower, it is much simpler technology than IC, right? And maintenance cost and anything is not there. You don't need distribution models, right? So, obviously, there'll be more players in the electric space which will come through. Maybe Infosys, TCS, not naming any company, maybe somebody comes in and tries to do something in electric car space. We don't know right now, but it could be in future. Yes, it could happen. I mean,
So Hitesh, sorry, coming back to your own persona, it's fascinating to see that you've been over 2 decades in this field, and you're loving it, right? So what is your secret sauce, and how can you share your journey? What are some of the pain points over which you prevail, you learned and kept on learning, and you are at the position you are?
I think it is mostly the inquisitiveness to learn, actually. So continue to learn, continue to question the status quo, try to understand why these things are happening, go out of your way, right? So people can do maintenance research, right? You can keep on analyzing the results of companies and stick to that, but that doesn't make your franchise, right? So you'll, as an analyst, you'll have to start questioning things, why electric shift will happen. You have to get into deeper details, you have to get into maybe tear down a vehicle, right? So tear down a vehicle and try to understand what are the components in electric and IC, and what components are getting disrupted, and will there be a change in the metal sector because of this, will there be a change in the power sector because of this, right? So you can do cross sector research. So try to get, the more deeper you get into things, you will try to get more topics to write on, more you'll be more motivated to do stuff like that, and keep you motivated. That's the thing which keeps you going, right? I mean, if you only stick to analyzing companies results and all that, that will not help you become a informed analyst. But see, for example, in valuations also, when I'm talking about DCF, it's not a simple thing to do a DCF, right? You have to, every line item in DCF, when you're putting in, there has to be a logic. So when I'm talking to a client, it's not like we are talking to a very informed clients who've been investing like 20, 30 years and know inside out into India and sectors, like senior fund managers and senior portfolio managers globally. They can just rip you apart if you are not, quite thorough in what your assumptions are, why you are taking these assumptions. So you have to have a logical flow to convince a client why he should talk to you, right? So being as a sell side analyst, it's very important to be in top 2-3 in your sector. If you're not top 2-3 in the sector, nobody has a time actually. And globally, or a senior fund manager or a global clients don't have time to talk to more than 2 people or 3 people in a sector, especially in a country, on a country specific sector, right? So imagine a global PM who is looking at Europe, US, Asia. He has to talk on India autos. So how much time can he spend on that? He can't spend too much time on that, right? So it's it's very imperative that you understand very early in your career, if you want to pursue sell side, that you have to be a thought leader. You have to be a differentiator in your work. Otherwise, you may not last long, in my view.
So talking of tearing down a auto vehicle, have you actually gone under the hood, Hitesh?
So I have actually gone to dealerships, got the full parcel. It's actually I have spent a year in Maruti. I spent a year in supply chain, in few months in supply chain. So I know the costing, some details on costings of each and every part and all that, and I've got those details as well. That what is the cost of each and every part and all that. And I've replaced a worker in a production line as well in Maruti for 2 months. So I know how assembly is done, what is cycle time. So I know the manufacturing process in and out. So that has helped me a lot in my journey as an auto analyst as well, to understand when companies talk about production efficiencies. I understand that very well. And I'm a production and chemical engineer as well. So
Yes.
from that perspective, I understand the metallurgy portion as well also. So that has also helped a lot in technically understanding the sector.
No, that's fascinating. I recollect because it's pertinent. I recollect one of the star analysts in City Research. He used to he used to go on sabbatical. So he was covering the 7-Elevens and Family Marts in Japan. And what he used to do is go and work in a convenience store, actually work there, and then come back and do his analyst job. So it's fascinating to know that, Hitesh. Thank you very much for sharing. One last question I wanted. There's lots of questions. I'm sorry I have not been able to uh, you know, cover all of it, is on books and resources and sites. You've already mentioned that there's lots of auto sector sites, associations that people should go and take a look at. Are there any books? Have you written a book? Do you plan to write a book? If not, what other books people should read?
No, so I'm not good at writing books. Don't plan to write any book as such. But yeah, so I mean, there has been books on Toyota's journey. I don't remember the name, but there's GM. There's a book from ex-CEO of GM. He talked about how he turned around GM. In the early days, what all things that he brought in. There's a good book on Toyota. How was Toyota was made actually, and what all, how they moved to a Kaizen system and all that. So those books can be read. Then there's obviously a lot of books written on electric these days. That's something to be read on. So if read as many books as you want, yeah, to really actually understand the industry. It's about knowledge actually, whether you're reading books or meeting industry senior professionals to understand that, going all out, gather as much information as possible, which will help you in your research. That is what my submission would be.
Thank you. We have run short of time, Hitesh. Thank you so very much for taking time out today and also preparing for the webinar. We are really very grateful to you as well as Udit for sharing your reference. I hope our viewers, I'm sure our viewers have enjoyed this session very much. I'm grateful for them for taking their time out in these difficult times. Thank you very much all. Our next webinar will be on 8th of July. It will be a career series. Don't miss it out. And we also have a fascinating insurance conference, which is on the insurance sector, a similar CAGR as the auto sector. It's a good conference to go and take a look at. So don't miss out on June 25 and 26 this week. That is Friday and Saturday this week. Thank you again. Stay safe, stay well.
Great. Thank you, Shani, and thank you, Arshad.
Thank
Thank you, audience. Bye.